Hello, it's Robert Miner with Dynamic Traders Group with our DT Reports video update just for our YouTube subscribers for Saturday, January 5th. And Happy New Year to everyone. I hope we have an exciting 2019 just like we did in 2018. So I'm going to talk briefly about a couple markets that are in position for specific trade strategies this coming week. And of course, if you'd like to know more details and have daily updates on trade setups and trade strategies, check out our DT reports at dynamictraders.com. And if you'd like a more comprehensive education on the trade strategies, the analysis and trade strategies we do, check out my book, High Probability Trading Strategies. That's available at amazon.com. Okay, let's get started. Well, let's begin with my favorite market. We take a look at this one almost every week. This is the ES or the S&P, and I've laid out the case that we're in a major bear market in prior videos. You can check those out, videos over the last 2 to 3 weeks. So go into detail on the long-term position and why we've probably in the initial stages of a bear market. This is the daily data off of the September 21st high, and there's 2 or 3 things to note here. Number one, if we're in a bear trend, we should not make a close above 26.49.25. That's the closing low of what I've got labeled a wave 1 or A. If we made a close above that closing low, that's what we call an overlap, and that's not typical of impulsive bearish trend. It would indicate that more than likely we just made an ABC correction and we're going to continue to a new high. So that would be an important signal if it should happen. I don't think it's going to, but if it does, I'm certainly going to reverse my idea of this market being bearish into the market's probably going to be quite bullish. So if the market is bearish as anticipated, we should be making a corrective rally off the December 26 low, and that rally should be complete no later than next Thursday, January 10th. As you'll see in a minute, we've got some closer in time targets to complete what could be an ABC correction. And more than likely, it would be complete by 26.27.14. That's the 61.8% retracement. If this is a wave 1 or 3, a wave 2 of 3 usually would make its corrective high between the 50 and 62% retracement. But we can narrow in a lot closer than just that. Simple retracements. Here's the 240-minute data coming off the December 25th. Actually, it's 26th low. If this is an A and this is a B, the ideal target for wave C would be 26.27 to 26.45. That's the 62% retracement that we showed in the daily chart. It's also 100% alternate price projection of the range of what I got labeled a wave A from the wave B low. So should the ES continue to advance and reach around 26.27, be aware that we're near the extremes on the upside of what it should be if we're making a corrective high. And we'd start taking a look at short trade strategies at that point. And certainly if you're long, bring your stops pretty close to the market. Over the next couple of days, that critical price zone coincides with the upper resistance parallel channel, which is a real typical target if indeed the S&P is making a corrective advance. So keep aware of that. I'm going to go down to the 60-minute data. Shows primarily the same thing here. I've got a couple other, one other key piece of information on here. The afternoon of January 8th, that's Tuesday afternoon, is the 100% alternate time projection of what I've got labeled a wave A. And so that would be the ideal time target to complete a wave C high. That's the afternoon, Tuesday afternoon. So we got the 100% alternate time projection and the 100% alternate price projection. I'm not forecasting that it's going to complete a wave C a Tuesday afternoon at 26.44, but what we do want to be aware is those time factors of where the market is if it continues to advance into that time period. And what's very important here is that should the ES trade below the January 3rd low, that'd be last Thursday's low, 24.41, that would indicate that this corrective advance is complete. And eventually the S&P should, well, not eventually, but probably fairly quickly, continue to decline to a new low below the December low. So that's a real critical pattern reversal signal and on decline below Thursday's low. That again would indicate this indeed is a correction. The correction is over and the bear trend should resume. And so what we're going to be particularly looking at is that 26, 27, 26.45 level. If the ES continues to advance into that level, ideally, if it does, it would complete a corrective high by Tuesday afternoon. Well, we've got some daily time factors that go into as late as Thursday, and Thursday would be the absolute extreme. If indeed the market's making a corrective high, and that's what we're anticipating that it's doing. So that's the ES over the next few days, at least the way we're looking at it. I'm not going to go over other charts. I will just say that gold has probably completed a weekly high, and Friday's outside reversal day. There's a lot of factors, time factors, price factors, dual time frame momentum factors that all came into play on January 4th to potentially complete a weekly high. So if you're in gold, bring your stops pretty close to the market and prepare for a probable weekly sideways to down. That means 3 to 5 weeks sideways to down for gold, silver, and the mining stocks. That's it for today. Be back with you next Saturday on our YouTube videos, and I hope if you like what you just saw, you'll check us out at dynamictraders.com. Take care.